Why do you hustle from morning till night, pinching pennies and living paycheck to paycheck, while your neighbor, who rolls out of bed at 10 a.m. and is never in a rush, buys a condo and regularly flies off on vacation? I always thought it was luck. It turned out to be math. I realized this on one of those late nights. There's this moment when you're sitting at your desk at 11 p.m., staring at the screen, and you realize you're exhausted. Not from just today, from all the days combined. Alex Graham knew this feeling well. He was sitting exactly like that, on a Wednesday in November, in his office chair with the armrest that had started squeaking back in September, but he never had the time to replace it. On the desk sat a mug of cold coffee, and next to it lay a folder with a 48-page contract he had to review by morning. He would review it. He always did. Alex was 34 years old, a corporate lawyer for a mid-sized real estate developer. Good salary, $120,000 a year, plus the occasional bonus. Not brilliant, but solid. He rented a one-bedroom apartment in the suburbs, paid $2,500 a month for it, put the rest into a savings account, and was making extra payments to early pay off a personal loan he took out 3 years ago for a home remodel. Everything according to plan. Everything under control. That specific word, control, wasn't just a habit for Alex. It was something of a professional identity. His job was to see risks where others only saw text. He read contracts the way others read detective novels, with a pencil, with questions, with distrust for every single comma. Clients paid him exactly for that, for not trusting beautifully written words. Yet he managed his own finances differently. Not because he was stupid, but because he was busy. He knew he had a loan at a 5% nominal interest rate, knew that every month he paid $850, knew that if he tossed an extra $300 to $500 on top toward the principal, he'd close it faster. It seemed logical, it seemed right, and that's what he did. Once every few months, Alex would open an Excel spreadsheet, look at the numbers, make sure he was moving forward, and close it. There was movement. Small, but it was there. He didn't complain. Complaining would have been strange anyway, because right in front of his eyes every day was a living example of how things could be different. His neighbor across the hall, Paul, 40 years old, worked as a content manager, or maybe just a freelancer. Alex never really looked into it. Paul was never in a rush. He woke up, by the looks of it, around 10 a.m. Sometimes Alex saw him at the local grocery store at 3 p.m. with a basket, showing absolutely no signs of urgency. He drove a car, not new, but decent. Once a year, he flew off somewhere on vacation. He owned his condo. Alex knew that for sure. Paul had casually mentioned it once by the elevator. Alex treated Paul with that special, condescending curiosity you reserve for someone who clearly doesn't live by the rules, yet somehow manages not to crash. It was a little annoying. Not a lot, just as background noise. According to the rules of life that Alex had absorbed long ago and never questioned, everything was logical. You work hard. You have a lot. Discipline, control, early payments, savings accounts. Paul didn't fit into this logic, but that was his problem, not Alex's. Sooner or later, Alex thought, things go wrong for people like that. It just wasn't visible yet. But time went on, and for Paul, things kept going right. Even better than before. In October of that year, Alex bumped into him by the mailboxes. Paul was in a good mood. He was generally always in a good mood, which was also slightly annoying. They exchanged a few words. Alex asked something neutral, Paul replied just as neutrally, and the conversation ended in 30 seconds. But something about that interaction stuck. Not the words, the tone. Paul spoke like a man who didn't have problems, not because he was hiding from them, but because he genuinely had fewer of them. Alex went upstairs to his apartment, sat at his desk, opened his spreadsheet, and stared at the numbers. Everything was in place. The loan balance was shrinking. Savings were growing. Control was absolute. And yet, something wasn't adding up. He couldn't articulate exactly what. Just a feeling, light, like a splinter under the skin, that he was correctly doing something completely wrong. That all this discipline, all these spreadsheets and extra payments gave him the feeling of momentum, but not actual momentum. That he was pedaling hard, but the bike was on a stand. He closed the spreadsheet, opened the 48-page contract, picked up his pencil. He had to work. It is exactly on nights like these, when exhaustion builds up and the numbers don't form the picture you expect, that people either start asking questions or stop altogether. Alex had spent his whole life asking questions of other people's contracts, never his own. Not because he was afraid of the answers, simply because he was sure he already knew everything. That was his mistake. Not stupidity, not laziness, confidence. The confidence of a man who knows how to read far too well. And precisely because of that, stopped reading what was right under his nose. It happened on a Friday, not on a Monday when a person is full of resolve to change things, and not on a Sunday when anxiety rolls in on its own. On a regular Friday, at 7:30 p.m., when Alex walked into a small coffee shop near the train station, just because he didn't want to go straight home, he grabbed an Americano, sat by the window, and pulled out his phone. Scrolled aimlessly. News, messages, more news. Then, for some reason, he walked over to a small shelf by the wall, where the coffee shop kept a few books for customers. An old tradition few people notice. Alex himself hadn't noticed it before. But that evening, the shelf was right there, and he just skimmed the spines. One book stood slightly crooked, out of line. Worn out, lacking a flashy cover. Something about personal finance. He didn't even catch the title at first. Picked it up just because he had nothing else to do. Opened it to a random page. There was a table. A regular table with 2 columns. On the left, a loan for $40,000 at a 5% nominal interest rate, a 5-year term, standard monthly payment. On the right, the exact same loan, but factoring in what the author called the APR, annual percentage rate, and effective cost. The numbers in the right column were different, noticeably different. Alex set his cup on the table. He stared at the table for about half a minute, not reading the text around it, just looking at the numbers. Then he started reading. The author explained it simply. The interest rate, the nominal rate, is the one the bank prints in bold on the first page of the agreement. 5%. Looks nice. Convincing. That's exactly what a person sees when they walk into a bank and ask, "What's the rate?" 5%, the loan officer replies, and smiles. But then there's the APR and the effective rate. It calculates everything, including the debt protection plan or credit life insurance the bank heavily pushes during signing, including the origination fees, if there are any, including exactly how the amortization schedule is structured, where the payments are equal every month, but in the first years, the vast majority of the money goes toward interest, not the principal balance. The author provided a specific example. A $40,000 loan, 5 years, 5% nominal rate. Monthly payment, $755. Looks straightforward. But if you add the debt protection plan, 5% of the initial loan amount annually, that's another $600 a year, or $50 a month, which simply dissolves into the payment and doesn't go toward paying down the debt. Total real overpayment becomes completely different from what the nominal rate implies, but significantly higher. The effective APR in this example wasn't 5%, but closer to 9%. Alex put the book down, picked up his phone, opened his banking app. His loan, $42,500, taken out 3 years ago for 5 years. Rate, 5%. Payment, $850 a month. He knew it by heart. He also remembered that during signing, the loan officer had offered a debt protection plan, and he agreed because she had said, "It's standard procedure. Everyone gets it. It costs very little." He hadn't asked how much. He was in a rush. There was a 3 p.m. meeting that day. He found his full payment history in the app. Then he found the contract. It was lying in a folder of documents Alex hadn't opened in about 2 years. There it was. Addendum number 3. Insurance terms. 1. 7% of the original loan amount annually. That was $722.50 a year. About $60 a month. Just gone. Not toward the principal. Nowhere. But that still wasn't the main thing. The main thing was something else. Alex pulled out his notepad, he always carried one, and started calculating by hand. He knew how amortization worked. You pay the same amount every month, but inside that payment, the ratio of interest to principal changes. In the beginning, the lion's share goes to interest. At the end, mostly to principal. He knew this theoretically, but he had never applied the math to his own loan. He calculated it now. In the first month, out of his $850, a huge chunk went entirely to interest. Normal, that's how it works. But he had been making early payments for 3 years, every month tossing an extra $300 to $500 on top, feeling proud of himself. And all this time, the bank was recalculating the schedule so that the extra payment shortened the term or reduced future payments, but didn't drastically change the interest-to-principal ratio in the current period. He was paying it off faster, that was true, but not nearly as efficiently as he thought, because the insurance premium kept being calculated based on the original loan amount. He sat in the coffee shop for another hour. The Americano was long cold. The amount he had overpaid beyond what he calculated, just because of the insurance and the amortization structure, was around $5,400. This was money he had honestly earned, honestly brought to the bank, and honestly lost. Not because of carelessness, because of trusting the big number on page 1. There are more mechanics like this than it seems. I break them down on this channel. Subscribe so you don't miss the next breakdown. He is a lawyer. He reads contracts professionally. He knows the devil is in the details. And he hadn't read his own contract. Alex put the notepad in his pocket, left the book on the table, not on the shelf, but right on the table, so the next person would definitely see it, and walked out into the street. It was cold. He walked home, even though he usually drove or took the train. He needed to walk. One thought kept spinning in his head. If he hadn't known this, what else did he not know? The next day, Alex woke up earlier than usual. Not from an alarm. He just opened his eyes at 7 a.m. and realized he wasn't going back to sleep. Lay there for 10 minutes, stared at the ceiling, then got up, brewed some coffee, and opened the notepad with yesterday's calculations again. The numbers hadn't gone anywhere. $5,400. He looked at them with the same feeling you get when looking at a dent in your car you just noticed. Unclear how long it's been there, but now it's impossible to unsee. He could have stopped there, cut his losses, learned a lesson for the future, closed the notepad. Many do exactly that. But Alex had a professional reflex he couldn't switch off. When you find one mistake in a contract, keep looking. The first one is almost never the last. The question was who to ask. He could have Googled it, could have found articles, forums, YouTube videos, but he had already spent an evening with a book and numbers and realized one thing. He didn't need text. He needed a person. Someone who knew the mechanics from the inside and could explain it simply, without trying to sell a course and without overly enthusiastic tones. And then he remembered Paul. Not immediately. First he thought of colleagues, then a CPA he knew, then for some reason, Paul. The neighbor from across the hall who was never in a rush, who owned his condo, who flew off on vacation once a year, who strolled through the grocery store at 3 p.m. without the slightest tension in his face. Alex used to attribute this to luck or an inheritance, but after last night, he had a different hypothesis. He rang Paul's doorbell at 10:30 a.m. A bit awkwardly, they had never really talked like this. Paul opened the door a minute later, in a t-shirt holding a mug, and looked at Alex without surprise, as if neighbors rang his bell every Saturday. Alex said he wanted to ask a few questions about finance, if he had the time. Paul stepped aside and gestured for him to come in. The apartment was simple. No showy neatness, no expensive items on display. A regular sofa, desk, laptop. The kitchen smelled of coffee. Paul placed a mug in front of Alex, sat across from him and said, "I'm listening." Alex told him about the book, the table, his calculations from the night before. Paul listened without interrupting. When Alex finished, Paul stayed silent for a second and asked, "Do you know exactly how your monthly payment is calculated?" Alex said he knew in general terms, yes. Paul grabbed a piece of paper and a pen. "Look," he said, "an amortized loan payment means the bank takes your entire debt, calculates all the interest for the whole term up front, throws it into one pile, and divides it by the number of months. You get the exact same number every month. Convenient for you. You always know what to pay. Extremely convenient for the bank, because the interest for the final year you are effectively already paying in the very first year." He wrote two numbers on the paper. The first, the amount of interest Alex had paid in the first 6 months of his loan. The second, the amount his actual principal had decreased by in those same 6 months. The difference was nearly double. Alex stared at the numbers. "So," he said slowly, "when I was making extra payments that first year, I was mostly just paying off interest, not the actual debt." Paul nodded. "Not entirely," he said, "but close. The extra payment hits the principal, that's true, but the structure of the remaining payments is recalculated so that you're mostly just shortening the term or dropping the future payment size. Meanwhile, the credit insurance keeps calculating based on the original loan amount for quite a while, depending on the contract. You are paying for something that no longer exists." Alex asked for more details on the insurance. Paul explained. Credit life insurance or debt protection on a personal loan is technically voluntary. But banks build the process so that refusing it means either getting hit with a higher interest rate or hearing from the loan officer that without it, your approval is in question. Most people agree to it. The insurance costs between 1% and 2% of the original loan amount per year. On a $42,500 loan, that's $425 to $850 annually. Money that doesn't reduce your debt, doesn't work for you, just disappears. Alex asked, "How did you figure this out yourself?" Paul shrugged. "I took out a loan once," he said, "and 6 months later accidentally calculated how much I was actually overpaying. I got curious. I started reading, not motivational books, but the actual mechanics. How APR is calculated, how compound interest works, why an S&P 500 index fund historically averaging 10% annually with dividend reinvestment actually yields way more over a decade." Alex asked him to explain that last part. Paul took the pen again. "Compound interest," he said, "is when interest is earned not just on your initial money, but on the interest that money has already generated. You put $10,000 into a brokerage account yielding 10% annually with reinvestment. By the end of the year, you have $11,000. The next year, that 10% isn't calculated on the original $10,000, but on the $11,000, making it a bigger gain, and so on, every year. By the end of a decade, you don't just have $20,000 like you would with simple math, you have nearly $26,000. The difference seems small in the short term. Over 10 years, it becomes massive." Alex was silent. Then he asked, "And what did you do when you realized this?" Paul answered simply, I stopped making extra payments on my cheap nominal rate loan and started putting that exact same money into a broad market index fund, utilizing compound interest. Then I learned how treasury bills and bonds work. Then I paid off the loan on its normal schedule, not early, and never took out consumer debt again. Since then, my money works in one direction, not two opposing directions at the same time. Alex returned home at 1:30 p.m., sat at his desk, opened his laptop, and went to his bank's website. Not the app, but the full desktop site, where hidden in the borrower section was an APR calculator. He inputted his data. Nominal rate 5%. Insurance 1.7%. 5-year term. Amortized payment. The effective APR on his loan was 9.4%. He stared at that number for a long time. Then he opened another tab and looked up historical average returns for broad market index funds. A standard S&P 500 ETF averaged around 10.5% annually with reinvested dividends. That was higher than the effective cost of his debt. The difference between those two numbers, between how much he was overpaying the bank and how much he could be earning himself, was the exact margin in which Paul lived. Calmly, without rushing, at 3 p.m. in the grocery store with a basket, Alex opened a new page in his notepad and started writing. Not a plan, not a spreadsheet, just questions he should have asked himself a long time ago. Mike Sokolov was exactly the kind of person Alex could have become if he had taken a slightly different path. Honors law degree, corporate career, great networking connections. They had met 5 years ago at a professional conference, and since then occasionally crossed paths at events and texted sparsely. Mike was the kind of guy who always knew the current numbers, the Federal Reserve benchmark rate, housing market indices, average market yields. He talked about it as easily as the weather. Alex had always slightly envied that confidence. In early December, they ended up at the same industry dinner, a small event, about 20 people, at a restaurant downtown. Alex arrived a bit early, Mike, 10 minutes later, in high spirits. They sat next to each other. Mike immediately shared his news. He had finally pulled the trigger on a mortgage. Alex nodded, asked casually, "What kind of terms did you get?" Mike answered eagerly. The bank offered a 6.9% rate, special program for existing clients. New construction condo, ready in a year and a half. 20% down payment, 30-year term. Monthly payment came out to about $2,600. It's totally comfortable, Mike said. I can swing it easily and still have cash left over. Alex asked, "Did you have to take the insurance?" Mike waved his hand. "Well, yeah," he said. "Without it, they would have bumped the rate up. So I got it. Homeowner's insurance and a mortgage life policy wrapped into escrow. It's standard." Alex asked, "Did you calculate the actual APR?" Mike looked at him with mild surprise. "Why?" he said. "The rate is transparent, 6.9. It's right there in the contract." "I read the contract. It's clean." Alex didn't ask anything else. He sat there, listening to Mike talk about the condo's layout, the neighborhood, how in 5 years the property value would definitely shoot up. He spoke confidently, with numbers, with logic. Everything sounded reasonable. And Alex caught himself thinking that 3 months ago, he would have spoken exactly the same way. Exactly like that, with a sense of control, with pretty numbers on page 1, believing that if you read the contract and didn't find anything suspicious, it meant everything was fine. He didn't say anything to Mike. Not because he didn't want to help, but because he knew from experience, both professional and now personal, that a person only hears what they are already prepared to hear. Mike wasn't ready. He had just signed the contract. He was at a point where any doubt is perceived as an attack on a decision that's already been made. Alex had seen this in negotiations countless times. He picked up his glass, took a sip, and started doing the math in his head. A 30-year mortgage. The amount, if the down payment was 20% and the payment was $2,600, meant a loan body of roughly $400,000. Nominal rate 6.9%. Mortgage life insurance, roughly 0.5% of the remaining balance annually. That's about $2,000 in the first year, slowly decreasing. Homeowners insurance, another $1,500 a year. Total insurances in the first few years add about $300 a month to the payment, money that doesn't pay down the debt. But the main thing wasn't the insurance. The main thing was the term and the amortization. 30 years. With an amortized payment over that long of a term, for the first 10 years the borrower is paying predominantly interest. The principal balance decreases incredibly slowly in the early years. If Mike decides to sell the condo in 5 years, he'll discover that out of his $400,000 debt, he's barely paid off $30,000. The rest vanished into interest. And that's at a nominal 6.9%. With the effective APR factoring in the mandatory insurances and closing fees, the real cost of the loan would be closer to 8.5% annually. Over 30 years, Mike would pay the bank nearly double what the condo is worth right now. Alex didn't consider this a disaster. A mortgage is a mortgage. It's a tool, and it has its own logic. The question isn't whether to take it or not. The question is whether you understand exactly what you are paying for. Mike thought he was paying 6.9%. In reality, he was paying more. And making decisions based on an incomplete picture. It wasn't stupidity. Mike was a smart guy. It was that very confidence, beautifully packaged, backed by a diploma and professional experience, that prevents you from asking a simple question. Am I actually calculating this right? The dinner ended around 10 p.m. Alex took the train home, standing by the doors, looking out the dark window. He thought about how, over the last 2 months, his life hadn't changed externally at all. Same job, same apartment, same commute. But inside, something had shifted. Not dramatically, no grand epiphanies or breaking points. Just quietly and irreversibly, like when your eyes adjust to the dark and start making out things that were always there. He pulled out his phone and opened his banking app. Looked at his loan balance. Then he opened a second app, a brokerage account he had opened 3 weeks ago, maximizing his Roth IRA contributions for the tax benefits. There was $1,500 in it. Not a lot, but this was the first money that was working in one direction, not against him. By the way, about how money starts working for you instead of against you, I break this down in my Telegram channel. No fairy tales about making $1 million in a month and no fake guru hustle. Just an honest breakdown of how the psychology of money works and why most people continue working for their expenses instead of their future. Link in the description. Subscribe if you want to wake up in 10 years feeling like your money is working for you and not you for it. He had bought broad market index funds in that account. Not because it was complex or clever, quite the opposite. Because it was simple, understandable, and historically reliable. Consistent compounding, market tracking, a yield higher than inflation. No gambling, no risk beyond reason. Just money sitting there, generating considerably more than a standard savings account. Simultaneously, he had stopped making extra payments on his loan. Not because he decided not to pay, but because he ran the numbers and saw, in his specific situation, given the remaining term and payment structure, that money worked more efficiently compounding in the market than it did early paying the loan. The mathematical difference wasn't astronomical, maybe a few $100 a year, but it was his money, not the bank's. He got off at his station, walked up to the street. It was cold, but he walked without rushing. Before entering his apartment building, he stopped for a second. On the 3rd floor, a window was lit. Paul was awake. Alex thought he should drop by again sometime. Not with questions this time, just to hang out. February, 11 p.m. Alex sat at the same desk, in the same chair with the same squeaking armrest. He still hadn't fixed it, kept putting it off. On the desk sat a mug of cold coffee. Next to it lay a folder with a 52-page contract that needed to be reviewed by morning. Everything was exactly like November. Almost everything. He picked up his pencil and opened the contract. First page. In large print, the deal terms, key parameters, numbers designed to catch the eye. He skimmed over them and immediately flipped to the addendums. Not because the main text was unimportant, but because he knew now. The real terms are always in the addendums. Always in the fine print. Always where people don't look. This was his client's contract, not his own. But now he read them exactly the same way. In the 3 months since that November evening in the coffee shop, externally almost nothing had changed. Alex went to the same job, took the same commute, ate lunch in mostly the same places. His colleagues didn't notice any difference. He himself couldn't attribute the change to any single event or decision. But the numbers had changed. He closed his laptop and grabbed his notepad. The same one, with the calculations from November. The last few pages were now filled with different numbers, fresh ones. Brokerage account balance, $3,200. He had been funding it every month, with the exact amount he previously threw at his loan as extra payments. $300 to $500 a month, sometimes a bit more. No heroism, no drastic sacrifices. He just redirected the flow. The index funds paid dividends, small but predictable. With the dividends automatically reinvesting, compound interest was beginning to do its job. Slowly, almost invisibly, but in the right direction. He continued paying his loans strictly on schedule. No extra payments. When his debt protection plan was up for annual renewal, he canceled it and got a standalone life insurance policy through an independent broker, not the bank. Same exact coverage, half the price. That alone saved him $360 a year, simply because he had finally read the terms and found the clause that allowed him to do so. The clause had been in the contract from the very beginning. He just never made it to that page. In total, over 3 months, his actual savings and passive growth amounted to around $1,200. Not a fortune, but it was money that previously just leaked away, quietly, monthly, without a trace. He put the notepad away and picked up his pencil again. There was one more thing that had changed, and it was harder to track in a spreadsheet. Alex had started reading whatever he signed differently. Not just clients' contracts, his own too. His cell phone bill, credit card terms, the user agreement of the app he used every day. He hadn't turned into a paranoid freak and didn't waste hours studying every single paper. He just developed a reflex to look for the second number, not just the first. To ask, what is the effective cost of this decision, not just the nominal one? It was the exact thing he had done professionally all these years. Only now, he was applying it to himself. In mid-January, his younger sister Kate called. She lived in another state. She said she was thinking of taking out a $10,000 personal loan, wanted to upgrade her laptop and do some minor apartment repairs. The bank was offering a 14% rate, the monthly payment was small, everything looked fine. Alex didn't give her a lecture, didn't start explaining amortization or APR. She hadn't asked for an explanation, she just mentioned it in conversation. He asked one thing. Did you look at the total cost of the loan? Not the interest rate, but the total amount you'll overpay over the entire term? Kate paused for a second, said, No, I didn't look. He said, Find that number in the contract. It has to be there by law. It's usually in the Truth in Lending disclosure. And also check if they slipped any credit insurance or debt protection into the loan. That's it. He didn't add anything else. 2 days later, Kate sent a text. Short. Found the insurance. Didn't even notice it on the first read. Caught it during the free look period. Canceled it, recalculated, saved $900 over the life of the loan. Thanks. Alex read the text, put his phone away, and went back to the contract on his desk. He didn't feel like a financial guru. Didn't feel like a man who had uncovered some grand conspiracy. There was no secret. There was just fine print that everyone sees and nobody reads. There was a difference between a nominal number and the real one. There were mechanics that banks don't hide. They just don't put them on page 1. It's business. It operates by its own rules. And those rules don't change whether you know about them or not. The only thing that changes is what you do with that knowledge. Alex finished reading the contract to the end, found 2 clauses his client needed to be warned about, made notes in pencil, closed the folder, grabbed his mug. The coffee was completely cold. He took a sip anyway. Outside it was February.